In this video, I'm going to show you 3 UK stocks to buy right now this month, and one stock that I am personally buying myself. Today we have set up a stock screener, and I think it's quite interesting the kind of factors I've looked for, and maybe it can be somewhat informative if you're looking to find new stocks to buy without just copying those lists that people create online. And if you like the video, please share one of these to help beat that YouTube algorithm, as it is much appreciated. And as like the last video, my voice is still somewhat recovering, so be prepared for some voice cracks along the way. So to start, I'm on Simply Wall Street. This is one of my favorite applications or software for investing. I think it's very simple, easy to use, and it's also quite cheap. A lot of investing software is quite expensive, and so I like this. It keeps it easy, and this is one of the ways I learned how to begin investing in the markets, because I picked up the important factors based on what was present on the screen, and I learned from that. But today I've got using their stock screener. I filtered by market. I've only looked in the AIM market. I was trying to get some higher growth stocks today, so I did do that. In hindsight, I probably should have added the FTSE as well, but I think it narrows our results down a little bit more. And it does make things a little bit interesting, because the AIM obviously isn't as well known as the FTSE 250 or FTSE 100, and so we could see some little gems perhaps. I'm going to scroll through the lot, and then I'm going to show you the 3 stocks that I found of interest. One of these is not included in this screener. But what you will notice is that on my advanced filters, I've searched for a market cap between 0 million and $10 billion. It's in dollars, unfortunately. That's just because of the way the site works, but effectively it's going to be around about 10 billion pounds. Well, at that point, it doesn't really matter. If it is a company of that size, I'm not as interested. And I've also gone down, I've ignored valuation. You will see a common trend here that a lot of these very high quality stocks, or these stocks on this list, they will have high valuations. So that might suggest that there should be some patience when entering these stocks, and perhaps some thought put into when to open a position. But then I've looked at like future growth estimates. I don't usually use analyst estimates, but I figured that it might rule out some companies that a lot of people, or a lot of analysts, think might do badly. So I've gone for a 3 years earnings growth estimate. I think 3 years is more sustainable. We don't want a company in the next year that's going to boom and recover from the pandemic and then just do nothing after that. We want long-term growth potential after all, and that's why I have these kind of stocks in my portfolio. I've put it between 15% and upwards. I think that's an interesting level. Obviously, I could filter it down and have it higher, but I don't think the analyst opinion is that important. But I do want them to filter out a lot of the lower quality stocks that we just aren't interested in. I've also got an earnings growth, so past performance. And you may say, you can't drive a car by looking in the rearview mirror. It's not a great way of going forward, and only looking at the past is not a great way to get future growth potential. But I like to see it because I want to see if their earnings are predictable. I want to see if there's a common trend along it, and then using that knowledge, look to why they may be growing in the future, and then have a little bit more of a think, and maybe think, yeah, is this the stock for me? So once more, I've put 15% earnings growth and higher, because I believe in stocks that grow faster than the market. And I feel that in the way that they give you value as a shareholder is by improving their underlying financials and fundamentals. And they'll do this by growing their revenue, growing their earnings at a faster rate than other companies. And I feel that that over the longer term will reward you more than investing in the likes of the market overall. Although I've not proven anything so far, and I am actually underperforming the markets. And then I've also got, for good measure, financial health. After all, you could have a company that's growing very rapidly, but if they've got a huge amount of debt, I think that's a bit too much. I've narrowed it down between 0 and 40%. I think that's a fair amount of debt. I think that's the point where 40% is where, if a company with a good management knows what they're doing, then they can leverage a little bit more debt to get further growth, but as long as they've got the cash flow to be able to pay it down. The screener on Simply Wall Street can be a bit limited. However, I'm very happy with that, and I've not added any other factors or filters into this. And so when we've searched for this, it's sorted by market cap. You'll recognize the first stock already. That's Boohoo. That's my top holding in my portfolio. I didn't even plan for that, but it was interesting to see that that is there. We've also got a few other big names like Frontier Developments, YouGov, Sumo Group, even TinyBuild. You'll notice that Frontier, Sumo, and TinyBuild are all in the same industry. They're all software developers, so that is quite interesting to see. Then we go down a bit. We've got a lot of asset management type stocks. We've even got Axis Technologies, which is a bit of an interesting one because apparently it produces and sells Accoya solid wood and Tricoya wood elements in the United Kingdom and other places. That's an interesting business. You wouldn't expect that to have too high of growth potential. I can see right there that there's an exploration of oil and gas. I always avoid exploration companies. It's well out of my understanding. I think it's a bit too speculative. And oil and gas and energy as a whole, I just do not like because I lack understanding in this industry. Scrolling down a bit, we have got some other interesting ones. We've got Shanta Gold. That's quite speculative, and I think that's actually also an explorer, but just a gold explorer. So we have got a lot of the riskier stocks the further we go down here, but there are some certainly notable names. One that I've seen before is also One Media IP Group. There's a lot of intellectual property as well. But the first stock I've got today is Keywords Studios. You may have clocked that one already. This is a fairly popular stock in the UK, and they provide integrated outsourced creative and technical services to the video games industry. So they work very closely with gaming companies and provide these additional services. And I wish I could give you an example, but I can't quite remember. When we come into it, past performance, yeah, cool, but we can look in the last year, we can see that it is perhaps downtrending. This downtrend could be a point where you might want to start opening a position, but when we zoom out a bit more, we can see that they have had some very, very strong growth in the last 5 years, and so you might want to step back a second and breathe. Don't get caught in the FOMO if there is any in this stock. And when we scroll down a bit more, we can see a bit about the company. It was founded in 1998. And that currently they have a very high price to earnings ratio. When we look at the market cap compared to the revenue, it's not unreasonable, but it is certainly a premium. But when we compare it to the earnings, it is a massive premium. This suggests that the investors are paying for quality. They believe very strongly in this company, and so they're willing to pay a premium on the shares of this stock because they are very confident in how well they do. Whilst I do like that summary, and that is a new thing, I'm going to scroll down. I usually completely disregard the share price versus fair value because it only takes into effect value measures, and it's not important in this whatsoever. We can see the price to earnings ratio is high. The price to book ratio, however, isn't as bad. It is above the industry and market, but it's not too far above the industry where you would go, actually, this is a massive premium. But we may also find that they might dispose of their cash, or they have a lot of other things that they need to use their cash to obtain, and so this might lower their price to book ratio, although not if they're purchasing more assets on the book. Obviously, we've got the future growth there. I'm not particularly interested in that. But what I am going to look at is the past performance. We can see in the last 5 years, they've grown their earnings by a CAGR, or compound annual growth rate, of 30.4% each year. That's very good on average. And we can see at the moment they've got 7% profit margins. And looking at the graph, it does look very promising about their growth potential in the future. I'm interested in their free cash flow because at the moment their earnings are quite low. I would like to see if their free cash flow is higher than that, if it is growing faster. And by the looks of it, they certainly have a higher free cash flow, which is promising. If this was a company that was perhaps unprofitable but had a positive free cash flow, that could also be a good investment case too. When we go down to the financial health, as you may already know, they're going to be of a good quality because they have little to no debt, 0.04% debt, high amounts of equity, and a strong amount of cash of 84 million euros. So this, as a whole, is a very quality business. They do also pay a dividend, although I don't think you'd be invested for a 0.048% dividend realistically, but it is due to be paid in the next 6 days of this video I recorded on Wednesday. And that could be of some interest for you, but at this level of yield, you might actually be better in a bank account, and it's not often that I say that, at least for only income perspective. And then I want to look at the management, which will be quite interesting, in particular the ownership. This is quite cool. You can see that there are individual insiders with some skin in the game. They've got 4.5% of the overall company, and that is due to, I believe, Andrew Day, who is one of the members, perhaps, of the board. And we do have a lot of institutions holding as well, which could be of interest. I did see earlier that they had roughly 9,000 employees and they have roughly a 0.4% overall stake in the company, but that could grow as the company gets bigger and that could take up a larger proportion, which could be a good sign, providing it's not diluting the shares like something on, for instance, like Tesco, where Tesco has so many employees and they're adding to the share pool because a lot of them are engaged in the share plan. Hopefully, if that's not the case, then this could be a very good growth stock. Although I'm comparing two vastly different stocks and of vastly different sizes. This is an interesting one. I do believe in the growth of the video gaming industry, and I think if you're tethered to it, there is certainly potential to be had there. The next stock on the list is actually the Aquis Exchange. Now, you may have heard about this if you looked into a bit more speculative stocks or if you frequent some of the investor forums. This is of interest because I did always like exchanges. I think it's a great business model. I think these companies really have a strong moat once they are built up, and that once they've done that, it's good. However, at the moment, I must immediately point out that perhaps this exchange is doing well because of the recent hype, or at least jump that a lot of people have done into the stock markets, myself included. The pandemic crash attracted a lot of attention. People are looking for a place with this low interest rate environment to park their assets. And so this could certainly be at a very premium valuation, and that their earnings could certainly go down in the future based on this. But then it really depends on how their business model and how they really generate income. Once more, we will see that obviously their valuation is 98.7 times on a price to earnings ratio. I believe that it doesn't matter what the overall price to earnings ratio is, as long as you are comfortable and patient with volatility, and as long as the story doesn't change in the company and they are still of a high growth, then you could certainly be patient, dollar cost average into the markets, get a good holding in a good quality growth stock. Although this would certainly apply to someone perhaps of closer age to me, being 21, rather than a closer age to retirement, unless it's a very small speculative position in your portfolio. When looking at the price to book ratio, we can see this is a very high premium, although with an exchange, usually they have to have some levels of debt so that they have that liquidity in terms of emergencies, although they may not have this, or it may not be written down as debt. Again, I'm going to skip through the forecasts. Whilst yes, they look promising, I'd rather look at the past performance, which we can see that they are currently doing very well. We can see that in the last few years they were certainly unprofitable, and that they actually became profitable in 2020, I believe the third quarter. And so that is pretty interesting, but we can see that their profit margins have scaled with revenue, and that is a good sign for growth in the future. In fact, it's done better than that. So over time, we can see the profit margins have increased, suggesting that as revenue gets higher, profit margins will get higher too. When we look at the free cash flow as well, that has followed suit, and this is also a good sign to see. When looking at the financial health, obviously it's going to be of a great quality, 0% debt and £13 million of cash, because after all, this stock has a market cap of £196 million. So that is a very good proportion of cash to have, and it seems like it is somewhat increasing, at least over a longer term period, but at least in the last 2 years it has remained relatively stagnant. They do, I believe, also have a management stake. Let me have a look. Yes, they have 28.1% of individual insiders. That represents serious skin in the game and is very much interesting. I believe we have a few names there that you'll be able to see. I'm guessing a name that I'm not going to be able to pronounce, and Richie, or I just butchered the name of that. The point is, management having that skin in the game shows that they believe in the company, shows that they are willing to have that amount invested because they have a lot of equity there. They could sell out, but they're not going to. And we have a very small amount of the general public and half institutions. So that could potentially mean that we may have quite an illiquid stock. So you do need to be quite careful on the spread between the buy and the sell price, because it may be a higher level of spread. And I'm talking about spread, but I mean overall that it's going to cost you quite a bit. Make sure to check that one. I imagine it's probably going to have a 5 to 10% spread on this investment. And if you'd like to sign up to my stockbroker Freetrade, you can get a free share worth up to £200 when you use my link in the description down below. And if you haven't already followed me on the likes of Instagram or Twitter, search my name, Osborne Foreman, or click the links in the description down below as well. And the next stock on the list is one I hold. It's Games Workshop. Lately, they've seen quite the drop, and here comes my voice alongside it, and it is also running out of steam, much like the shares of this stock. Developing and making miniature figures is a great business model. I'm not going to chunder on about this. I don't think chunder was the right word there. I'm not going to throw up, but you get the point. The idea is in the last month, half a month, shares have dropped from £122 to about £104. This could be of some value, but this is because they cut their dividend. They said their profit was as expected, although freight, shipping and supplies were actually higher than usual, so this is eating into their profit margins, meaning the growth might be a bit more flat. What we do have interesting about this is that their price to earnings ratio is much more down to earth, and this might be a trend when you look at the FTSE 350 stocks, because I did only look at AIM, but this kind of quality stock could have a difference as well. Although I suspect there'll be something different here that means it wasn't part of that investigation or screen, which we'll find out very shortly. The price to book ratio, though, is quite premium, but this is because they regularly dispense their cash from their balance sheet as a dividend or truly surplus cash, and so this makes a lot of sense to me. Although I would rather that they kept the dividend actually and reinforce it to grow their own business, and then slicing their dividend in half or nearly half in the most recent quarter, I think is very good, because it means they can invest more money, have more capital available. Even though they don't believe in inorganic acquisitions and growth, there is certainly potential there. And then when we look at the past performance, it is truly fantastic. 30.5% CAGR in the last 5 years. Growth of the earnings has gone up with revenue, scaled and done better. Very high profit margins of 34.5%. Free cash flow has been consistent alongside that. And the financial health is obviously of a very good quality. Absolutely no debt in the last 6-7 years and mounting levels of cash. This is great to see. And so we could see some more higher investments that they put into their own business, or into things like I'm on about in the future, moving away from the miniature figure model, or at least milking that and using it as a cash cow, because they are vertically integrated, leading to their high profit margins, and investing a lot of money on TV, using their IP to create TV series, films, even their own video games. Their royalties are a great example of this. They sell their branding, their licensing to other companies to use, and then they pay a royalty fee. This transfers immediately from the revenue pretty much entirely to earnings, and that is a great thing to see, but it is also an easy way for them to get income. So it's good that they are growing very well elsewhere. The main dominance area that they have is actually North America, and they are growing at a much faster pace, and it is their largest overall market size in terms of revenue diversification. And North America growing by the most is a good sign to see, because that is obviously one of the biggest consumer markets, and a lot of the companies that I have in my portfolio have a much more UK dominance, and that isn't the best, although the UK is good for consumers. My voice is really going now. They do have a dividend of roughly 1.5%. Don't forget they cut the dividend. This might not be looking directly into that, but the payout ratio is about 50%. I like that actually. I think that's even reduced now with that dividend change. That is a great sign to see in the future. And with the management, I don't know if there is a significant skin in the game, which we can actually see there is not, because a lot of the board and shareholders, I believe, is it Kevin Roundtree? He's created a lot of growth for the company, but he was never the original owner, and so he has only a very small stake. But we do have very good investor sentiment aside from the movement in the last few weeks. This is a stock with my highest conviction, one that I've been buying myself in my portfolio. And if you're interested in the UK stocks I'm buying right now, then click the card at the top right of the video. I hope you like the change of format and the way I've kind of encompassed a screen into my stocks to buy. And I hope you have a fantastic day.